Chapter 5. Taxation and Compliance. Taxation and compliance are fundamental aspects that determine the legality and sustainability of a company's operations. Corporate tax obligations are not limited to paying taxes on profits. They also include accurate reporting, withholding and collecting certain taxes, and complying with applicable administrative tax regulations. Business law literature emphasizes that the tax system serves two primary functions: as a source of state revenue and as a regulatory mechanism to monitor corporate economic activities. Through taxation, governments are able to fund public services such as infrastructure, education, and social programs that indirectly support the business environment. At the same time, the tax system ensures that companies contribute fairly to the economic ecosystem in which they operate. In addition, tax compliance helps maintain transparency and accountability within corporate financial management. When companies follow tax regulations properly, they demonstrate responsible governance and strengthen trust with regulators, investors, and the public. Consequently, taxation is not merely a financial obligation, but also an important component of corporate legitimacy and long-term business stability. Corporate tax obligations. Corporate tax obligations generally include the duty to pay corporate income tax on taxable profits earned during a fiscal period. In addition to corporate income tax, companies may also be subject to value-added tax or goods and services tax, sales tax, dividend tax, withholding tax on employee salaries or payments to third parties. The amount of tax payable is typically determined by applicable tax rates, deductible business expenses, specific provisions such as tax incentives or tax credits. In practice, companies must engage in lawful tax planning to optimize their tax burden without violating legal provisions. Proper tax planning is a legitimate business strategy, provided it does not constitute tax evasion. Effective tax planning may involve evaluating available deductions, utilizing government incentives designed to stimulate investment, and structuring business transactions in a tax-efficient manner. However, the distinction between lawful tax avoidance and illegal tax evasion must always be respected. Tax evasion, such as falsifying financial reports or deliberately concealing income, constitutes a serious violation of law and may result in significant penalties. Filing requirements. Filing requirements are a crucial component of tax compliance. Companies are required to submit tax returns periodically, either monthly or annually, depending on the jurisdiction's regulations. Tax reports must accurately reflect the company's financial condition and be supported by proper accounting records and documentation. This includes invoices, receipts, payroll records, and other financial statements that verify reported transactions. Failure to file reports on time or submitting inaccurate information may result in administrative penalties, fines and interest charges, criminal sanctions in cases of serious violations. Therefore, maintaining a transparent and well-documented accounting system is essential for fulfilling reporting obligations. Many jurisdictions now require companies to submit tax reports electronically through digital tax administration systems. These systems allow tax authorities to monitor compliance more efficiently and reduce opportunities for fraud. As a result, businesses must ensure that their internal accounting software and reporting processes are compatible with modern digital tax platforms. Managing tax compliance. Managing tax compliance requires companies to implement effective internal control systems to ensure that all tax obligations are fulfilled accurately and on time. This may include establishing a dedicated tax department or function, engaging professional tax consultants, monitoring regulatory changes, as tax laws are often dynamic. Additionally, companies should conduct periodic tax reconciliations and internal audits. Multinational enterprises must also prepare proper transfer pricing documentation for cross-border transactions. A proactive compliance strategy not only minimizes the risk of disputes with tax authorities, but also protects the company's reputation in the eyes of investors and other stakeholders. Strong compliance practices demonstrate that a company operates responsibly and adheres to the rule of law. Furthermore, effective tax management contributes to better financial planning and corporate governance. By integrating tax considerations into strategic decision-making, companies can ensure long-term sustainability while remaining fully compliant with applicable legal frameworks.
Okay, see you on the top.
Yes.